We are on.
I think we're
Hello,
live.
everybody.
Yeah.
We are very excited to have a special guest, Eric Bowden, today. Eric is not only an appraiser, that's how many people in the Houston area know him, but he's also a very accomplished investor. So he brings a very unique perspective to the people who are regular attendees of our real estate market update. So very excited to have him here today. Also, welcome, Jeff.
Hello.
Yep. So for those of you that do not know, we are a one-stop shop for real estate investors. We can go to the next slide, please. No, one back. We're going to whoa, there we go. We're going to get there. There we go. Here's what we're looking for. We'll go over this and then we'll cover our value proposition. But Eric, I'm going to sing a little bit of Eric's praises and I'll let him talk about what's going on in his world. But Eric has, we really care about relationships in general as a company, and we have some people that we've been working with almost since the day we opened up. And Eric is definitely, he and his team are definitely one of those relationships. Incredibly experienced, really understands the Houston market better than anybody. He's built a large team, so it's not just like we're working with Eric individually, but he's built a great team, and they definitely have learned from him and can execute appraisals. That's a sign of a great leader because they do a very strong job. He may have to get involved sometime, but for the most part, his team really understands the business and they do a fantastic job. So I can't give enough praise to him and his team. If you're looking for an appraisal group, I think they're fantastic. So Eric, that's my praises for you. Tell us what's going on in your world.
I appreciate it, Wade. Everybody, I'm Eric Bowden. I'm the owner of Bowden Appraisal. I love doing these webinars and chatting with Wade and Jeff about the market and giving some of my personal insight as an appraiser and an investor. I own Bowden Appraisal. I own Bowden Realty, which is a real estate firm, and I own an investment company. So I'm active in many aspects of the industry. For Bowden Appraisal, this is a large firm, at least large for what you would call for an appraisal firm. So we have a staff of 13 here. Everybody is a certified appraiser that works for me, and it's taken a long time to build, a quality group of appraisers, and especially a group that would service a company like Wade. Wade is built for Catalyst. So, expertise in investment and, being able to imagine a property based off of someone's rehab or their vision of the property is definitely a specialty in the industry. Not everybody's got it. I feel like we've got a strong handle on it. But yeah, take it away, Wade. I'm happy to help and bring in my insights as it's needed here, and let's have some fun.
Yeah, I'll say one more thing before we move on. And Eric
Sure.
touched on this, which is the appraisers that most hard money lenders do, almost every one of them, is a subject to repairs appraisal. And that is a very unique skill set. One of the unique things that we do at Catalyst is that we have panels that we build out not only for our hard money loans, but maybe more uniquely in comparison to other hard money lenders, our long-term loans are also built off of this model. And we have a special appraisal called a bridge appraisal, which eliminates a significant amount of the risk of the second appraisal coming in light. It never happens with our platform if it's followed properly. But it's not that it couldn't happen. It just almost never happens if it's followed properly. But the key thing about this conversation is that Eric and his team are not just the average appraiser, right? They're the average appraiser goes out, a home's in pristine condition. They look at comps that look exactly like the home as it sits. And it's honestly a lot easier thing to do. What Eric and his team do and what appraisers work with hard money lenders and do it well is they have the vision, the foresight to see here's a scope of work. And this property often is in deplorable shape. Like it can, some of the worst shape you'll see if it's a really good deal. And they have a vision to say, here's what the home will be worth whenever all those repairs are done. So it's a very unique skill set and one that many appraisers really never master. So the fact that Eric and his entire team do it so well is definitely rare.
I appreciate that, Wade. And us being a team with y'all is, again, props to Catalyst having the platform and the group to execute as well. Yeah.
All right. We're going to go on to the disclaimer. So this is for general information only. No information, documents, or estimations presented here are for investment advice. We're just giving our opinions, and we're not liable for any investment decisions that you might make. Next slide. Jeff, you want to cover a few key things from our value proposition?
Sure. So, like Wade said earlier, we are a one-stop shop. We handle hard money. So folks that want to buy distressed properties, fix them up and either flip them or refinance them. We also handle the long-term loans as well. All of our loan officers are licensed for conventional loans or DSCR products. A couple of quick highlights that I'll touch on. We have a unique advantage. We do not require any kind of loan to cost. We do 100% financing. So if you find yourself in a good deal, compared to maybe some other lenders, a lot of times you won't have to bring any money to the table if you find a great deal. And the other thing is we just rolled out a HELOC product. So if you are looking to pull cash out to maybe buy more properties, you can get with us. We can do HELOCs on investment properties up to 90% in some cases. So you can really maximize your leverage, get some cash out to go buy more houses.
Yeah. All right. So we dive right into it. Houston, that's where Eric and his team are based. That's where Catalyst has its home office, although we have boots on the ground in both Dallas and in San Antonio. But Eric, what are you seeing in the market in these numbers and just your own personal experience?
They're following what I'm seeing, Wade. I reviewed this before our webinar started, and I'm seeing the same thing. So I'm seeing, pretty steady home sales for the past year. I'm seeing it relatively stabilized. And even inside there, my experience is different from just looking at numbers. So, I've probably done personally over 15,000 assignments, and then my staff does, 20 to 30 real estate appraisals a day. So we're also meeting people out there, talking to a ton of realtors. What I'm seeing follows this pretty accurately, in my opinion. I'm seeing a relatively high inventory, but I'm also seeing a pretty consistent sale rate. So if you're seeing that, you're seeing an absorption rate or a monthly inventory. That's where you'll see the absorption rate. But a monthly inventory currently at a 5.5. I'm reporting something very similar, Wade and Jeff. I'm seeing about a 4 to 5 month inventory out there. However, I'm seeing the sales kind of stay with it. And a lot of times I'm hearing a softening from the market of their take on interest rates. So, as the interest rates have somewhat stabilized, I think it's the same thing with our buyer pool. They're kind of getting more comfortable with that interest rate and what it means to buy a house these days. So I'm seeing a lot of these numbers in my personal business as well.
Yeah, I think we've been saying for a while that there are a lot more active listings, but it's not really trickling down into the numbers. And it hasn't this is not a new development that there are more listings than there were prior to COVID, right? This is not some new development. You can see it's been basically the same for a year, but Houston is the only major metro that has an increase in prices year over year, right? So while it is a lot of listings that are out there right now, a lot of inventory, the market is very resilient. The months of inventory is not all the way into a buyer's market yet, right? It's still below that 53 days on market, but it's a little bit higher than it was in July of 2019. Not a significant difference. And where the rubber meets the road is on the home price appreciation, and that's a pretty steady number. So I think in many ways, Houston's arguably the best of the major metros right now, especially because of that increase in values year over year. Mm-hmm. What about you, Jeff? What are you seeing?
So I look at, like you said, the home sales and the listings, and if you compare pre-COVID to what it is now, it's a massive difference, right? The sales are pretty similar, but there are 2x the listings. So how do you have that with prices out going down? I think it's being. Can you tell me if you agree or disagree, Eric? I'm curious, but I think the influx of people moving to Houston is bringing so many people coming in, it's kind of propping up or keeping the sales prices where they are because there are people flooding in to the city. So even though they aren't selling at nearly the same clip they were 7 years ago, there's so many people coming in. There's enough folks that want to buy properties where price drops aren't happening. The one thing that I noticed on here that I thought was pretty interesting was the leased listings. Do you guys look at that? The 5,200 versus 4,600. That is a massive difference. So that tells me that people are they're just it's become, and there's a slide down the road, but it's just more expensive to buy a house now. And so you have all these people moving in. Some are able to afford to buy houses, and that's what's keeping the prices up. But then the folks that aren't, they're leasing, right? Because that is a big chunk, up 12% year over year. So it's good if you're buying rental properties. I got to believe those leases, the prices will eventually start following the volume and start going up.
It's up 12% year over year and up 31% from pre-COVID.
Yeah.
Right. So,
Yeah.
But the sales are only up 8%. So I mean that's significant.
Yeah, I mean that's inevitable. You see the median sales prices from COVID 2019 to July 2026. The median sales price is $340,000. I mean that's going to lead to having a great investment as a rental property. That people are going to have to occupy something. And so having an investment portfolio with rentals is a very strong portfolio right now.
for sure. Yep. All really good points. The days on market on the rentals significantly less than the days on market for sale. Now that's a different process. Admittedly, there's a lot more that goes into buying a home than to leasing a home, renting a home. But still, to Jeff's point, it seems like the rental market in Houston in particular is very robust. Lots of it going on there, and as the people move in, and that's not an uncommon trend. A lot of people move to a new area, they rent for a couple years, get to learn the area, the neighborhoods they like, where they want to be, the amenities that attract them individually, and then they settle into buying a home. And I think that's probably even more pronounced, as Jeff said, because of the difference in price. So you kind of have two things working in. It's not the most common thing that people that move into a new city buy right away. That's not always the case, especially in a higher interest rate environment, right?
Mm-hmm.
All right. So next we have Dallas, which for a very long time frame was the without question the hottest market in Texas. And in all honesty, there's still a lot of prognosticators because of all the Fortune 500 companies and the industry moving in. I saw something that's the AI capital of a data center capital of the United States. There's a lot of positive things going on, but the property prices are down, 2% on both the median and the average year over year. Although the long-term trend pre-COVID, still the most positive story, being up 61% on the average and 47% on the median is pretty incredible in that time frame and well above any other major metro. But that it is interesting that market has definitely pulled down more than the other markets in the past year or so. What else are you guys seeing there?
Very similar. I remember seeing this the Dallas market on the last time I joined y'all's webinar, and it was the hottest one of the four major markets that you were covering.
Yeah.
So,
do you guys ever? I don't know if you go to like industry events with other appraisers or have any other intel that's kind of not in the numbers here that you hear about Dallas lately.
not so much for Dallas. I think it's different. A different industry for the appraisers, just because of the geographical competency of it. Mostly we would focus on, specifically the Houston market, and then the other areas in which we service, which is like the Beaumont and College Station areas and stuff like that. So I don't have any specific information for Dallas. I have, however, heard the same thing you heard, Wade, which is the industry of the data centers and AI being significant here and in West Texas. So I can only imagine that it'd be interesting to see this table next year, as that stuff continues to proliferate in that area and more and more people come into work there. I'd be kind of curious if Dallas rebounds. That's an interesting thing to look at for next year.
Yeah, we do have a slide. Go ahead, Jeff. I'm sorry.
I'm sorry. I would say, yeah, like you said, month over month, everything's slightly down a little bit. But if you step back and look at the big picture, pre-COVID, it's still the leader by a good bit. Um, the thing that's interesting to me is the leases are down, and I think just from talking to some wholesalers up in Dallas, like most of the things in Dallas proper, most of the investment properties they're buying they aren't necessarily rentals because the price points are getting higher. So the rentals are going out. They're going, into the tertiary markets, maybe in the Fort Worth side. But the Dallas market, it is pricey. At some point, rental properties get priced out. So it doesn't surprise me that the leases are down. Obviously, look at the rents are massive increase, right? Like 1864 to 2700. So I mean, if you think about, you bought a property 7 years ago, you've been able to raise your rents almost $900 on average, which is a huge win. And that's what we talk to folks about buying rental properties now, because a lot of folks say, hey, the interest rates are higher, I don't want to buy, et cetera, et cetera. Cash flows are down. Okay, maybe they're not that greatest right now. But if you look at the long-term trends, rents typically go up, and they should always have the refinance event if rates drop. So, it's just, that is to me, that is a big raise when you didn't do anything, and you're able to simply maintain your property and get a $900 a month increase. That's real money. So that's what I saw that popped out of me.
Yeah, compared to Houston, you're talking about being up over that same time frame, 27%, whereas Dallas is 46. That's huge difference.
Yep.
All right, San Antonio. San Antonio has there was a time here in the past 3-4 months earlier this year where San Antonio was the biggest success story. They had the highest appreciation. Definitely a bit of a pullback here. Surprising pullback, honestly, because it was up 3 to 5% just a few months back. But the months of inventory is 6.1, and then the looking at the days on market at 81. Those are slower moving markets than anywhere else in Texas, and it's starting to kind of creep into the price increases year over year. All that being said, I still think that whenever we look at the affordability index later on, compared to what people earn in that city, it's the most affordable of these 4 major metros by far, right? So I think there's still a lot of upside there, but definitely a pull down at this moment. Anything else you guys see?
I see an advantage here. If you're an investor that's looking for, a hold property for lease, I see an advantage. I mean, most of the time, in an appraisal industry, the absorption rate, which is also here labeled as month's inventory, is usually a direct correlation to a median sales price. It's not identical, like if that goes up, that goes down. But most of the time, the more listings you have, the more inventory you have, you're going to see, price reductions in the sales of property, and then you're going to see those numbers correlate. The higher the month's inventory, the lower the median or the average sales prices might drop, right? And you can see that here in San Antonio. It has a much larger inventory for current July 2026, and you're seeing a 3 to 5% drop in the sales prices. But it looks like the lease price is holding steady. You see that, or if not increasing. So why not use that as an advantage as an investor? Go in there and purchase a property in a buyer's market, and then hold it for a lease, and turn that into an advantage. I see San Antonio being an advantage on that aspect.
Yep, for sure. Jeff, anything else jumping out in San Antonio?
I think Eric's right. Like the long-term prospects for the Texas economy in general are very strong. They're very close to Austin. Like they have little mini ups and downs, but the fundamentals are really good. And to your point, like prices are down. I noticed the sales are up. I mean, that's a pretty significant jump, right? 14% up. Dallas is down 3. Houston's flat. So like the actual volume is increasing. And even though the prices are up, it is a huge drop on the number of leases. So I don't know if people are are just dropping prices and people can buy, and that's what's going on in San Antonio. And because it's just, if you look at the comparison, Houston and San Antonio, the number of leases, Houston's up 500, San Antonio is down 500, which is pretty significant in a town that size. So I think more people are buying homes, or just probably prices dropping a bit. And so
Well, and you have construction occurring in San Antonio. So you're having new construction at a lower price point. So you're seeing a higher home sales rate because of that as well. As you expand an area, and you're getting MUDs and PUDs and PIDs coming in there and building more affordable housing, you're going to see that number come up, but you're also going to see those listings go up because of the home builders.
that makes sense.
Yeah.
And so a lot of that's hidden in these tables, because you've got to get, more into the weeds on each one of these cities as to why those numbers might look that way. But every one of these markets is expanding in that way, right? You're getting more city councils allowing MUDs for expansion. In those expansions, you're getting new construction that may increase the home sale number. Like you have a 14% increase here in San Antonio, right? However, the sales price might be going down because of what they're building, right? It's a different product. And even on top of that, if you've got a home builder that's coming in and buying up 40 acres and developing it, they're also going to have a bunch of listings, whether they're actively built or proposed to be built, is going to affect your absorption rate there.
That's a good point.
Yeah.
That's a good point. And I actually have heard something about that in Texas, that the new construction builders are taking the average sizes down a little bit in their new developments, because it's just, the cost of materials, inflation, everything is so high. So you are going to see a balancing effect. That's not necessarily the same home selling for less. It's just the new home inventory being smaller, and maybe not as well finished out either, to get those prices where people can actually buy the homes, which is very logical, right? Like why try to put out a product that is 15% larger, has 15% better finishes, and then people really can't afford it, right? That's kind of pointless. So that really makes a lot of sense what you pointed out, Eric. I'd forgotten about that article I read, but that makes a lot of sense.
Yeah.
All right, Austin, the absolute poster child, not just for Texas, but for the absolute country in the height of COVID, right? No single major metro had more home price appreciation than Austin at that point. But Austin has definitely pulled back. It's flat year over year, up 30% from pre-COVID. A lot of other cities have passed it up from that pre-COVID number. San Antonio has passed it up for that pre-COVID number. Houston has passed it up. Dallas obviously passed it up. So it's a very interesting story. We did show a chart. I'm going to say this is 3 or 4 months ago, where the long-term trend for Austin appreciation, it's back in line now, because it had that huge jump up and it's kind of come back in line. But it is a story that it's either been flat or down for quite a few years now. I think that eventually bounces back for many reasons. It's one of the most desirable cities in the country, and also in Texas, but that it is just not growing like it was before, for sure. Jeff, I know you spent a lot of time in Austin. You got family there and stuff. Anything else you're hearing on the ground over there?
No, it's the Rickometer. Anytime he gets letters in the mail saying "buy my house," I know things are going good. Then when he stops getting them, I know things are going down. So it's a pretty simple little method to track it. But yeah, I was surprised. Like, I know we always talk about, and it is still the most expensive. It's still $35,000 more than Dallas.
No.
Like, at some point, you're going to start be able to maybe creep into the rental market in Austin if it keeps dropping. Meaning, I know we always talk about Austin as, if you're really going to cash flow, you need to start doing multifamily, duplex, 3-4s, etc. But eventually, if these numbers stay flat or drop a little bit more, you might be able to start picking up a handful of single families here and there in Austin.
I think further out, it's kind of like the Dallas concept. I think further out you can do it, but there are an enormous amount of duplexes, triplexes, quadplexes in Austin compared to Houston in particular. It's not comparable. Like, there's just not that many here. But that was a big part of the new construction that took place in Austin for quite some time, to be closer to the fun parts of the city, et cetera. So I do think that there's a lot of opportunities there. And just for those of you that do not know, you can take advantage of conventional loans up to 4 units. So it's a very good idea. It's single family 1 to 4 where you can acquire conventional loans. That's one mortgage. So it's a really good idea. And also there's a fun hack that you can do as a homeowner if you're willing to live in one of those 2, 3, or 4 units. You can actually buy it as an owner occupied and have very low money down in an FHA loan. So if you're someone who's willing to live right next door to your tenants, maybe you get that late night knock because the toilet isn't flushing, who knows? But it is an excellent way to get into owning small multifamily by using the very low down payment allowed with an FHA loan. So just if you have any interest in that, we can chat about it.
So
I'm writing one of those right now, Wade.
Are you?
I'm writing an owner occupied in Houston purchase where they're using the income from the currently rented other side of the duplex as a way to get into that property really cheap and cash flow it.
Yeah.
It's a really cool deal. You got to be willing to share a wall, right? But
Yeah.
you know, it's a great financial decision for sure. You know,
100%. I mean, candidly, how many people live in apartments or something like that, or they live in 0 lot line properties that are very comparable, right? But the out of pocket on that can get down to 3.5%. Where if you're buying non-owner occupied properties, you're never going to be anywhere in that zip code to have that low of an out of pocket, right? It's just never going to happen.
Yep.
All right. I was really excited with this slide that the marketing team found. Texas economic growth continues in 2026. So I'll turn this over to you, Eric. What about this and what your own personal knowledge really spoke to you?
Well, I'm seeing it, you know, in the Houston area for sure, right? So we've got the Exxon campuses, we've got a ton of headquarters that have come in and blown up our market in a positive way. We've got, in fact, one of my good friends is being headhunted by like medical areas that are coming into this area as well. So specifically, you know, the headquarter areas of Texas being, you know, income, personal income, where you don't have to pay taxes on that is a huge factor for these companies coming in and just killing the market in a positive way. So you're getting a lot of construction around those areas. We talked about that in San Antonio, but anytime you have like a headquarter or a large corporation coming in and creating jobs, which is all around at least the Houston area, it's coming in everywhere. You're going to see builders coming in and picking up land, right? Going through the mud and pit process with the county and developing. And competition is a good thing in real estate. It's not a negative thing, right? So I'm seeing it mostly in the new construction market expanding. And then a lot of investor purchases for rental inside of those neighborhoods that are close to these larger companies coming in. We've got Amazon is creating quite a few new distribution centers in this area, quite a few oil and gas. We've got a lot of medical. We've got medical development companies coming into the Houston area, which is interesting. It's more a scientific approach. So at least in my area, I'm seeing a ton of this growth, which has a lot to do with the home sale number going up in this area as well that you saw on that slide. It's not just resale properties, it's development, you know, lots of land area in the Dallas and the Austin and the Houston markets for them to come in and create new developments for all the people that are coming in, right? You've got an influx of population.
Yeah. I did a little bit of prep work before this and I'm going to roll through some names of companies moving to the greater Houston area. Chevron, this has been around for a while, but moved its corporate headquarters to Houston from California. ExxonMobil moved a massive corporate relocation to your neck of the woods there, Spring Woodlands area, Eric. Expand Energy, the largest natural gas producer in North America, relocating from Oklahoma City to Houston. Hewlett Packard corporate headquarters moving here as well. Those are huge. These aren't just like, top 1,000 companies. These are Fortune 50 companies, right? All huge companies. And then what I really found interesting is that we've been having corporate headquarters move here for a while, but the new manufacturing opportunities, because that's so much more expansive, right? Like manufacturing jobs hit, blue collar type jobs, and manufacturing is fantastic. And that Apple's moving that Mac Mini production, like they're going to build it here, they're going to finish the product here. They're not doing every small little piece of it, but that's really exciting. And then also, you mentioned it a second ago, biomanufacturing as well. Like a lot of manufacturing jobs are coming to the area, which is really good, so it doesn't become imbalanced. That's one of the tough things about Dallas is it's a lot of corporate headquarters, not a lot of manufacturing. So I think that is really given some diversity, which is important.
Yeah, the thing that I read about the article was interesting. It's like basically like you have both sides of the country, both coasts are not business friendly. They are finding ways to increase taxes, propose billionaire taxes. Um, and so I think the business owners, short of people in Silicon Valley or Hollywood, like the business owners are thinking, why would I want to run a business in a state where they're looking to take more of my money
Mhm.
and move it to a place that is welcoming me with like I said, no income taxes. But the other thing is like just the employee quality of life. Like it's not just the companies. It's easier to recruit individuals. You know, if
Mhm.
you want to live in a high tax state, it's tougher to get people to move there. It's real easy to get somebody, hey, come to Texas, where we're not going to tax you. All the jobs are coming here, and there's no intention of like there's no climate for increasing taxes anytime soon. So, um,
No, you've got quality jobs coming in.
yeah,
Um, you've got a lower median home price, right?
Mm-hmm.
You have no income tax, right? All these things point to a pretty strong real estate arena here. So very
Yeah.
good.
To y'all's point, like how much, like really, the purchasing power that
Mhm.
you give an employee is super important, right? That's what the bottom line is. If you, it feels nice, I guess, if you're living in California and you get an extra 20% over what you might make in Houston, but that 20% extra is not going to give you comparable quality of life. You're probably not going to be able to buy a home. Gas is going to be more expensive. You're going to be taxed even higher. So like you're going to have higher tax and less income across the board. Homes are going to cost more. Everything's going to cost more. So yeah, the quality of life that can be provided for these companies to their employees, they're a lot happier, and they don't have to give them more money, right? So that seems like a win-win across the board from a company's perspective. All right, so this is a really good slide. This next one is also very interesting, and I thought this would be a really good one to you to speak to, Eric, if you don't mind.
Sure. Let me go through it one more time. See, opponent takes home price decline to continue to moderate. Yeah, this is what I was talking about. So the the overall trend may show a decline, right? However, what I'm reporting and seeing on the ground here is a mostly stable market.
Mm-hmm.
Um, so the 4%, that number, and any of the other numbers, right? Because all four of these markets that you service, the Catalyst services, has a similar scenario with growth. Okay, so a lot of that, what you're seeing as a potential lowering of median or average home prices is what the product actually is.
Yep.
Okay, that's different, right? It's not saying that all of the homes, 1970s home or 1990s home or River Oaks, where you've got multi-million dollar houses or things like that. I'm not seeing in my profession a clear linear dive in home values. I'm seeing the price change because of the product, right? And that information is gathered into a larger group of information for all home sales prices, right? And so I think that that has a big factor here. I'm seeing, I don't know, probably at least 20 plus appraisals per week in my company that are new construction. They're new construction or they're recent construction in recently developed neighborhoods that are near these industries you were talking about, Wade and Jeff. that are expanding because the workforce is expanding, and they're creating new housing opportunities, whether that's for rent or for purchase. And a lot of those, a lot of the more starter home developments have special options for investors, if you call them, that you can buy, a multiple property package for the purpose of renting them at a lower price that's not listed online. Again, these things are going to be incorporated into the larger data set that may show a decline. But in my opinion, and from what I'm seeing, I do not see a decline in this market. I see a stable market.
Yeah, to your point, I'd love to see this data separated out on individual homes, right? Like,
Yes.
what are the individual homes that were already existing? Are they flat, slightly decreasing? That answer, I think we would say is no, because we look at those same comps all the time, right? I think it's
Correct.
new construction inventory. Yep.
The main factor here, so the new construction inventory is going to be exactly what you're talking about. They're taking a feasibility study of that land, and because of the rising labor costs, the rising material costs and tariffs, right? They're reducing the land size to incorporate a more accessible price point, right?
Mm-hmm.
To get that home. That is not the case in resale properties. And the main
Right.
factor there is that the land is appreciating, right? So most of the time, I'd say, I'm going to guess over 90% of my assignments, the land value is increasing consistently, just the dirt in which the property is sitting on, right? Now, the home might offset that through its own depreciation, being an older home, maybe it's well maintained or not, right? But the two offset is relatively stable in this market, especially in the resale market. The home prices for new construction have to be separated into what kind of product they are to determine whether or not they're increasing or decreasing, because you wouldn't want to compare, a $700,000 new construction to a $200,000 new construction.
Right.
But
Yeah.
in my
Yeah.
experience, Wade, both of those are also stable.
Yep. It's a great point.
Yeah.
Let's go to this next slide. Jeff, maybe you could start us off on this one. What are you seeing here?
Yeah, so when we talked about it earlier, sellers are still cutting prices, right? It is definitely a buyer's market. I thought it was interesting that, they're actually dropping more this year than they did last. If you look at the chart, they're dropping more in Austin and San Antonio, which makes sense because, like we saw previously, those are the two softening markets. I think it's, the reality is, my guess is a lot of folks bought these properties and just had an expectation of what it was worth, or they just have really low interest rates, and so they feel they need to like maximize what it's worth, and it's just they're just not getting it. So when I see these things, I see an opportunity for investors, because if you just look at the total number of available properties, even though, like you said, Eric, the prices aren't dropping for all the reasons we discussed, there's so many properties available.
I love it.
It's just the list price is almost irrelevant to a certain degree. You got to look at what is it really worth, and the reality will eventually hit, and people will drop the prices.
Yeah, what I see out there, guys, it's a combination of a bunch of stuff, where I personally see it in my company and all of the appraisers. I review everything that comes to this company, so I see a ton of appraisals every day, every single day. List price to sales price ratios, right? So you got a list price and what it actually finally sells at. That's what we're talking about. We're talking about 3.5%, 4.5%, 5.5%, 4% in DFW, 4.9% Houston. That's saying, the current list price to what it finally sold for is a gap. Okay. It has a lot to do, guys, with absorption rate. It always does, right? So if you've got a bunch of listings, a bunch of opportunities for buyers to go out there and look at 7 or 8 properties in the desired area, they're going to go for the one that has the most attractive pricing. As an investor, I love it. I eat this stuff up and I invest all the time right now. I love investing in buyers markets. The trick to it, in my opinion, is to be honest with your ARV, to look at a true valuation, not something that you want, But I always make my investments knowing these numbers right here. This is extremely important information that Jeff and Wade is giving to your investors right now, to look at this number, knowing that the majority of your listings are not going to reach what your original list price or your hope of your list price is, right? Set your ARV at the bottom of that and make sure you're profitable, and then utilize the buyer's market to your advantage as an investor and go in there and steal a property, right? If you're going to flip it, you got to be honest with these numbers, and you got to be honest with what that ARV is. And as long as that number and your acquisition works, it is a fabulous time to invest, in my opinion.
Yeah. Also, just the seasonality at this moment is very good for flippers, right? Because you think about this, it is a challenging time to sell a home in the, you got a little bit of a boom after Labor Day, but once you get to Thanksgiving through January, very slow time to sell a home. And people are trying to sell a home, whether it be an investor or whether it be somebody who moved to another city and they're holding 2 mortgage notes or whatever the case may be. All of them know that. So it's a really good time to buy. And by the time you're on the other side of your rehab, you're going to be putting it on the market at a really good time. You're going to be putting it on the market in the spring. So you can use that seasonality to your advantage with this data that's more generalized, but also that seasonality factor is a really big deal. Because I can tell you, anybody who's holding a property right now, and I have a few myself where I'm trying to sell them, you have a window, and that window pretty much closes right around a week or 2 before Thanksgiving, right? So everybody knows that, and you can make some aggressive lower offers because nobody wants to get stuck in that time frame, and it's right around the corner.
Yep.
I'm going to ask for a catalyst first here. Can we, based on this conversation, can we skip to slide, I think it is 17, because it directly points to what we just discussed.
Oh, perfect.
So
you take it, sir.
Well, can I? I don't know if I can.
Someone will have to move it there, but you can.
Who's driving? Keep going. Keep going. Next. One more. There it is. So this is exactly what you're talking about. This is the seasonality of when it's best time to buy a home. I'm sorry, the best time for home buyers to get a deal. So if you look at that, the blue is when it's good to buy. The red is when it's good to sell, right? Yeah. Obviously, there's variables in the properties and whatnot. There's all kinds of stuff. But just as a general rule of thumb, if you're going to buy a property, now's the time, right? Those blue lines are pretty pronounced all the way from August till about maybe January is when it starts to flip. So if you're get a deal, you get a deal. I'm not saying I see that thing, Eric. If you get a deal, you get if you get a deal, you get a deal, right? But to Wade's point, now is a great time to buy these properties, get them rehabbed, and if you're going to flip them, have them ready to hit the market by February, March, right?
Yep. And Jeff, I tend to agree with you. This is a great slide to jump to. And I think probably based on time, we've had a great conversation. There's a couple of slides I thought were really good that the marketing team found. So if we can't go back 2 to 15, I think this is a really good slide. This is talking about renting an apartment or a single family home takes less income than owning, right? And it's covering the major areas which we're in. And the spread difference here is really interesting, right? So where is the largest spread? Not surprisingly, Austin. We talk about how that's not an easy area in which to have a rental, right? The single family owned price is 32%. That's a pretty big spread down to 24. So it's just a lot cheaper there to rent than it is to buy. But some other areas are a lot tighter, right? Like look how tight San Antonio and DFW are. We're talking about a 5% delta, not that big. Houston, 8%, right? Kind of close to Austin, honestly. But yeah, some very interesting stats there. And these numbers are more pronounced today. Like it was closer in the past because of where interest rates are. If interest rates come down 2%, these compress significantly, right?
Yeah, those are great. No, it makes me feel good because if you look at Houston and San Antonio, if you go back to the beginning of the slides, we talked about how there's so many people renting in Houston, relatively speaking, versus the buyers. And in San Antonio, it's the opposite. There's a lot less actual renters, but more people are buying. The prices are not as good in San Antonio, but there's more volume on the buy side and less renters, which makes total sense, right? It's cheaper you can afford a home relative to renting one in San Antonio. So that's why there's more purchases and less leases and vice versa in Houston. Totally makes sense.
Yep. All right, this next slide, renting motivations. Eric or Jeff, did either of you have a particularly strong takeaway from this?
I personally did not. No, I thought it was pretty similar to the other one.
Yeah, I think we've touched about a lot of that. What's the advantage of renting versus owning, and the difficulty of people getting into those purchases. So we talked about that when I first saw that San Antonio slide, that it's a great time to go buy and hold property right now.
Yeah. An interesting stat here. Everybody talks about, and this is not necessarily great information if you're a real estate investor, but I think it's just an interesting thing. Everybody talks about how much more expensive it is to own a home today. And in many ways it is, but probably the most compelling thing is this. If you look at this family structure shapes housing choices, people are getting married so much later today, right? But back in the day, I mean, it might have been, they might have gotten married much earlier in life. And right now, like 73% of dual couples with children can afford a medium priced home, where it's only 40% of single parent household. That's a very interesting number there. All right. Let's go to, this is a really good slide. Data ranks, Dallas ranks #1 globally. That's a big statement. #1 primary data center market in the world. Right? AI is also accelerating demand. DFW's data center inventory grew 43.7% year over year. That's a shocking number to me. That's huge growth very, very quickly. And if there's going to be, whenever I see somebody called like #1 in the world or powerhouse, and this is an industry that's arguably growing more than any other, it seems like a very exciting place to be. While San Antonio, Austin, and West Texas rank #1 in secondary and tertiary markets as well. So a lot of growth there. These are typically very strong jobs, good opportunities for folks financially. So that should definitely help increase these home prices significantly.
Mm-hmm. Yeah. I mean, if you just let me talk about like what does Texas do well? Regulatory environment. We're pretty big, so we got lots of land. We let you build on it. We have power and infrastructure. Like it's a perfect environment for building these types of facilities, right?
Yes.
Although I just noticed this. Now Virginia, I did not know Virginia was #1, I guess, or allow it to rival Virginia in total data center capacity. I didn't know Virginia was the mecca of data centers, but yeah, this all makes sense. And it's only good for us.
I did see one thing that, for people who are concerned about this, which I can understand some people being concerned about it. The governor did come out with something saying that anybody who builds new data centers going forward is going to have to be like, they're going to have to produce enough energy to where they give back to the system they can't take from the system. A lot of people are afraid that, energy prices are going to go through the roof because of these data centers. But if there's a requirement that they either are net neutral or give back to the system, to the grid, that's a real positive thing, right? There's no real downside from an energy cost perspective if that is a requirement. So I thought that was a subtle but important move. So it's not just open up the floodgates. We don't care if people's energy prices go up. It's a more balanced approach, but it still, I think, is going to allow a lot of growth because it's not as aggressive of a stoppage of the growth as some other states might have. All right. You mentioned this earlier. You've got some friends in this life sciences medical space. Tell us what you're hearing here, Eric.
Just the bio side. It's just a new industry. A lot of it's located on the East Coast right now, at least of bioengineering. This is like stem cells. This is development of medical products. Some of those are coming in. One of them, I think this one actually is on the northeast side of Houston, um, just south of Lake Houston. And a lot of these facilities need access to water as well. So I know that this one's coming in northeast of Houston, but this whole the whole bio industry has begun infrastructure in Texas, mostly coming from the East Coast, whether it's in a lot of them are Massachusetts right now, but they're moving here because of what Jeff was saying, the regulatory openings and the ability for financial success for these companies to move headquarters here. But what's brilliant is that it creates really strong jobs. I mean, think about what kind of job that is, and then you've got support jobs on top of that. If you're not a scientist or anything like that, you've got tons of support, tons of construction jobs created from this. And again, watch this happen. So up there in the northeast side of Houston, you get a facility like this, okay? But then you got all this land over there, right? So this is an industrial area. You got Amazon over there. You've got other distribution facilities over there. Guess what? I bet's coming. More housing, right? More housing, more residential development, and economic impact on the real estate side. So if you're an investor, pay attention. Look at this stuff. Get in there early. You know, this is time to do it. Go in there and get it. You know.
I'm going to ask you, talking about Houston. I know that your area of expertise. I think it was last month or the month before, there was a slide that talked about Waller County being like the second fastest growing county in the country. I don't know if you saw that.
Yes, specifically up and down that corridor, Waller, Hempstead, land values are skyrocketing. They have been up and down the west side of Houston, especially Fulshire and the energy corridor, but it's expanding. I mean, it's like anything. You create more businesses like this where you've got high paying jobs, you've got high paying support jobs, and people want something bigger than what you're getting in these areas, which is the new construction on smaller lot sizes. Guess what? Land values are going through the roof, right? Guess where the land is? Waller, Hempstead, right? These are all important things to look out for as an investor. I look out for them all the time personally, you know, opportunities to get in before something is built, paying attention to the news about that kind of stuff, where are the highways opening up, where are the exits opening up. These are great investment opportunities, whether you're going to buy and flip or buy and hold, or if you're going to buy land. I mean, it's fabulous area. Waller is huge. I see that, you know, you've got Texas A&M. They've got a little campus over there as well. That's been increasing land values in that area for duplexes, triplexes, fourplexes. Great area to invest. Yeah.
Yeah, we hear big numbers thrown around a lot, and sometimes we become desensitized to it. I know I do, but $2.3 billion. This is one campus.
Just one.
That is an enormous number, right? Like,
well, they're probably going over budget. It's probably going to be more than 2.3.
Yeah, I read a book about projects and going over budget, and something like 95% of them do.
Almost every one of them does.
Yeah, there's a good chance that 2.3 is going to be, you know, at least 3 or 4 probably. So, yeah, it's pretty incredible. All right, let's look at this next slide here. All right, Jeff, a lot of information here. What are you seeing on this particular slide?
Yeah, it talks about like the diversity of the industry here. It's no longer oil and gas and whatever else. Like there are so many different type of jobs. They did talk about like banking consolidation, which I thought was interesting. Like a lot of the smaller banks getting gobbled up by the larger banks. I don't know. You talked to a lot of bankers, Wade. I don't know if you're seeing the same thing. But it was, you know, primarily just how Houston is getting more diverse with all of the different industries that contribute to it, to where it's truly no longer just an oil town. Obviously, that matters, but there's a lot of stuff that, you know, it's more of a global type economy, or at least nationwide type economy, than just a local one.
Yeah, I mean, I don't know that has drastically increased in the last year or so, but a constant part of banking is that banks are acquired by others. I mean, we've gone through that. I mean, half of the banks we raise capital from today were bankers who were at another company that got bought or merged, and then they move to another bank, and then we continue the relationship with them. So that's a constant part of these small commercial banks getting bought up. There's no doubt about that. But I mean, you can definitely sense it back. The only real problematic time in Houston real estate in recent memory, I mean, like last 4 or 5 decades, was during the S&L crisis slash oil and gas challenges that Houston had in the 80s, and prices were really problematic then in Houston. Like a lot of people lost a lot of money. But since Houston became more diversified, you don't see that as much. Houston's a very different city than it was in the 80s. So many more corporate headquarters that are completely outside of oil and gas has really put us in a much better spot. These, AI and technology, manufacturing outside of oil and gas, life sciences, like Eric was talking about, just a lot of very unique categories that are not going to be as influenced or challenged if oil and gas prices drop, right? So that's super important for us, no doubt about that.
I know we only have like 4 minutes left, and we have actually 4 questions already fired up into the queue. I don't know if we want to skip to the affordable index or get to the questions.
We can go over the questions.
Today we have highly engaged audience, and the first question to Eric. Does Eric appraise multifamily properties?
Sorry, I didn't catch the end. Does Eric appraise what?
Multifamily properties.
Oh yeah, I've got one in front of me right now. I do multifamily regularly. Yes.
You seeing any? So you're talking about apartment complexes and whatnot, right?
No, so okay, that's a good
small,
question, Jeff.
like 1 to 4.
Yeah, that's a good question. So multifamily, in my definition of multifamily, is 1 to 4 units.
Okay.
It's not an apartment complex. Okay, anything that goes over 4 units is going to be a commercial assignment. So I don't handle the commercial appraisal side. So it's all residential. But that being said, if the definition and the person that's asking the question is a duplex, triplex, and fourplex, yes, I do those all the time.
Those are anecdotally, those are like anytime I see, we do a lot of DSCR loans.
Mm-hmm.
Sometimes it can be a challenge to cash flow.
Mm-hmm.
However, when I see a 2, 3, or 4, it's a no-brainer. I know they're going to cash flow. Like the duplexes, triplexes, and fourplexes. If you can find one of those, like you have to try hard not to cash flow. Like they're a great way to balance out your portfolio. If you have a couple single families that maybe aren't cash flowing as much, and it's more of an appreciation play, you pick up a 2, 3, or 4, you can get some instant income.
100%.
All right. Next question is there a new 1% rule in Dallas and Houston now? Meaning, is the rule now 0.0% or something else?
I'm guessing what they're asking, and you can tell me. So is there a 1% rule in DFW in Houston now? Meaning, is the rule now 0.8 or something else? I'm assuming that's a question about rents relative to values, maybe.
Yeah. They're probably talking about a return.
Like a $2,000, maybe like a $2,000 rent on a $200,000 house is a little bit less than that. That's my guess as to what they're asking. I don't know what you're seeing, Eric, as far as like cash flow.
I'm not seeing a 1% these days. I'm just not seeing it. I'm seeing the home prices being higher than the obtainable rent. What most investors will do to offset that is get multifamily, like what Jeff was talking about. Multifamily is a great, or a 2 to 4 unit, or even higher if you want to go commercial property. But you need to get more units on the same note to get the ROI higher, to a 1% or higher. Most, if not all, of the purchases I'm seeing can be close. They can be close to 1%, but the majority of them are going to be underneath a 1% these days, from what I'm seeing.
Me too.
Yeah.
Yep.
And I know Marusi's having a hard time with the connection. I'll read this one. So, what are your thoughts regarding flipping house strategies in these markets in Texas?
I mean,
General.
we got another hour.
We got about 1 minute.
Yeah. Y'all want me to take it, or y'all can take it?
Yeah, fire. Go ahead,
Sure,
please.
go ahead. You're the guest.
If we got 1 minute, I teach classes on this too. The number one thing is to do your homework, and it seems so simple, but people, investors get bombarded by wholesalers. They're looking at listings, they're looking at foreclosures and auctions and all kinds of different ways to acquire property, right? And just remind yourself that the people that are giving you that information are also biased, right? They have an intent to sell something to you. Just remember, like when you go to buy a car or anything like that, right? Do your research and be honest with the research. Be honest, guys. You have to be honest with what you're looking at. The value and the return on the property is always in the acquisition of the home. It's always at the very beginning of the home. Okay. You have to acquire it right. But how do you know to acquire it right? Is being honest with what it would potentially sell for at the end of the day. It has to be honest. You cannot take the highest sale in the market and base all your numbers off that highest sale, and definitely don't do it off of the listing. Okay. Hire someone, call me, call Wade, call Jeff, where you get information on the actual sales prices of these homes. Okay. That's why we are here. That's what we do for a living. Okay. Make your purchase of the acquisition off of a real number of what it can sell for in the ARV, the after repair value. That is number one. Number one. The information you're given by wholesalers is often wrong. The information you're given about what it could potentially rent for is often wrong. The information about what it would cost to renovate that home is often wrong. Okay. Do your research on the property and make sure that you are comfortable with the acquisition and that you've got enough gravy on the end to make some money. That's
One thing I would add to that, all fantastic points, is also do not take the price per square foot and then assume that the largest home in the neighborhood is going to get that same price per square foot. We routinely see that from newer investors. Wholesalers will often put out numbers at that. Not all of them, but some of them will. And that is a mistake too. Sometimes a home is just overbuilt for a particular neighborhood, and no one's going to want to be paying 10, 20% higher than any other home is sold. And just be very cautious about that too.
That's all, folks.
Is that a wrap?
Yeah, there was a question about how to get these slides.
Yeah, but so we could send that out. Just put your information on emailing it out. I guess the last thing we'll say, Eric, if somebody does need an appraisal, how do they reach you?
Come on with it. You can get a hold of me. I'll give you my personal cell phone, because I know a lot of people like to text that information. My phone number is 936-537-5344. My name is Eric Bowden, Bowden Appraisal. You can find us online at bowdenappraisal.com. Please reach out. Oftentimes I would give you free advice. Like if it gets a little bit more in detail where you need something more official, yeah, we'll talk about some type of consultation. Trust me, guys, if you get into something that's interesting, that's not, some of these investments can get very interesting on trying to figure out what they're worth. Okay. Don't do it alone, and don't trust the people that are selling it to you. Okay. Do your own research. Call me, call Catalyst, make sure you get a good team set up so that you're prepared for that investment and that you're not surprised on the back end and you're holding the property. Okay. 936-537-5344.
Excellent. Then we have one last thing, which is a giveaway, right, Mauricio?
Oh,
Yes, and the winner today is Kevin Simmons.
yeah. Hey,
That's a familiar name.
Kevin Simmons.
All right, check your email right after this webinar, please.
All right. So once again, thank you so much, Eric, for joining. As always, amazing information, great takes. Appreciate you so much. Thanks everybody else for joining, and you guys have a great afternoon.
Thanks, Eric.
Bye-bye, guys.
Bye-bye.